Welcome to our latest webinar for corporates. In this series, we'll be examining recent events and looking ahead at what might be in store for financial markets and the economy.
Good morning, everybody. Welcome to the first webinar of the year. I'm joining you today from a slightly different location from normal. So I'm currently in our Edinburgh offices, so hopefully things will run smoothly. And we're going to do things slightly differently today because it was the end of the quarter and the end of the year. I'm going to hand over to Piers to present the technical outlook first, and then I'll go after him. So Piers, if you're standing by and ready, I'll let you take over, and please give us your views on what the technicals told us at the end of last year and what they're likely to point towards for 2024.
Be a good start. Yeah, Happy New Year. Thanks, Neil. So what are we going to look at? We're going to look at the markets today. We had that die down into the end of the year, and now in January, the market's trying to find its feet, its start of year direction. It's always a bit of a tricky time. You can get some false moves and everything like that. Everyone's sort of concerned which way the equity market's going. That's going to have a big impact on the dollar. Are they going to go down? Are they going to go up? Will that pull the dollar up? Will pull the dollar down? So we're going to try and look through now at some charts and see what we can see and if we can start to have a look. So the first chart, the first slide we're going to look at, as ever, is the dollar index, because I think that's key to the markets overall. Now, this is the same chart we've looked at for some time. It's a quarterly chart. We had the Bollinger Bands on there and the retracement levels. Now, one thing is that if we look at this chart and we look at towards the end where I put the sellers are dominant, they're fighting back. The large candles recently have been red candles, negative candles. So we've seen the dollar weaken from its strength of, a couple of years ago. It's now starting to sort of weaken back down. But as that move gets down towards the 97, 99 area, that's the 38.2% is the 97, and the 99 is the 20 period moving average. I would expect some support to arrive. So that's going to be a key area to watch as this course develops. So are we going to see a continuation of last year where the market sort of wanted to test down towards the end of the year and see a slightly weaker dollar? Are we going to find support? If it's going to find support, it needs to find it in that 97, 99 area. If we start to get below there, then we could see even further dollar weakness. So that's an important one to watch as we go into this first quarter of the year. So we know where the support is located and what we need to be watching there. What about resistance? So markets always have two ways they can go, up or down. And what we have on the resistance side is the 104, 105 area. We've highlighted that sometime. It's 23.6%. We want to see price above that if you want to see a stronger dollar. That would confirm, yes, the dollar is strengthening. But it actually really, to get on a sustained period of strength, you need to see price back above 109. So above 104, 105, it loses that negative feel, a slight more positive feel. But to get very positive, you need to see it over 109. 90, as I say, 97, 99 area, that is where you want to see the support. If you start to see this below 97 on a quarterly close or sustained trading within this quarter below 97, that would be a blow to the dollar bulls and a big win for the dollar bears. So that's the dollar index. We'll now go and look at how that looks for currencies. So if we go to the next chart, here we have euro dollar. And I often think sometimes we overcomplicate things in life. We try and make it too complicated. Too many factors come in. So this is a quarterly chart from when just after the euro started, year 2000. And we draw a trend line going across it. And that trend line, as you can see, was tested 3 times, 4 times, 4 or 5 times actually, but 4 times after it started. And we broke below it. And we saw a strong move once that line broke. And it went below parity down to the 95 area. And actually at that 95 area, on that October, when it got down there, on these webinars, I actually highlighted that was a change in the risk reward, and we should start to see it go back up. And we saw that rally back up. And where did that rally back up go to? This is the important part. It went to that trend line. So the old rule of support and resistance, the rule of polarity, support changed to resistance. And it's that simple, really. If we look at the last 1, 2, 3, 4 quarters, it's been capped by that trend line. So that's basically a year that trend line has capped it. And I haven't had to worry about interest rates, central bankers, people speaking after dinner, politicians, interest rate moves, inflation, just that simple line. And that's how simple it can be at times. So what do we know? We know that's the resistance. That's held it for a year. So if you want to think euro dollar's going higher, you want to see euro dollar above that line, because at the moment, the sellers are selling off that line. But the move back down, and can we just go to the next slide? I'm not sure I zoomed in on this or not. I put the retracements here. So on this slide, you can see it's also the 23.6% retracement. That comes in at 110.72 and the trend line about 113. So we can see that's the area that's capping euro dollar at the moment. Now, if it can break above that trend line, then it opens up sort of the 117. Well, actually, first there's a target of sort of 115, 115 and a half. Then it opens up 117 and 120 as potential targets. But we can see that at the moment it's falling off that 23.6%, the 110.70 area. Now, the last few quarters where it's got up and stalled at that 110.70, it's moved back down, but been held by the 38.2% of that rally up. So while I see that as resistance on the top side at that 110, 113 area, I know that the 120 area, where it keeps going down to, sorry, not the 120, when it goes down here to the 38.2%, that is the support. And that's around about 106 area. So 106 against 110 is your initial range. You can have, there's smaller intermediate supports between that, around about the 108.75, followed by the 107.25, 45 area. But the main support is 106. So 106 against that 110.70 area, that's a good range to start with. A break outside that starts to show you who's winning this battle. Now, so to keep it simple, let's summarize it. Below the trend line, price is going to go back and test where support is. So watch the 108.75 area, followed by that 106 area. Below 105, then something's changed and we're going to see euro dollar go lower. Any confirmed close above the 110.70 area, above the trend line. And I think we're going to start to see 115, 117, 120 area. But you've got to wait for that break. The market's not convinced either way at the moment. But it hasn't had a good fall off that 23.6% or trend line yet. It's managed to keep coming back and fighting it. So that's what we've got to watch as the quarter progresses. So we go to the next slide. I'm going to go to the sterling index here. So this is really important for sterling as a whole. We've had this for some time and it's worked really well. We've watched that 38.2% retracement. And so that comes in around 64.90. It kept the market for years from 2017 right up until 2023 last year. It broke last year. And where did it go to? It broke the 38.2% and went up to the 50%. It failed at the 50% and has come back down. But the rule of polarity, like we're talking about that trend line on euro dollar, is acted as support now. The old resistance has switched to support. So while you're above 64.90, then sterling's got some strength and could test higher towards that 67 area. Where is support? Support should be now below that 64.90, the main support is the sort of 63.70 area, which we can see from that 20-period moving average. But I would sort of give it a bit of wiggle space. So I'd say while you're above 63.50.70, then sterling has the chance to strengthen. Below 63.50.70, something's changed. People don't like sterling so much, and you can see sterling weaken. So keeping it simple, let's watch 63.64 against 67, the top there. And why do we know the 67 area is good? Because if we go to the next slide, I look at the yearly chart, because this is the start of the year, and look what capped sterling index last year. It was that 20-period moving average that held it. And we also know it's the 50% on that quarterly chart we looked at just now, the 50% retracement. So that tells us the 67 area is the sort of main resistance. So 67, 69 should cap any rallies, I think, in sterling this year. And then 63, 64 should hold pullbacks. Now, if either of those two levels break, I will keep you posted and I'll update you. But having looked at the sterling index and sort of thought what's happening here, you can see it's just gone sideways. So that yearly chart is actually quite good. Look at that big fall down in 2015, 16 time. It collapsed down and all it's done is gone sideways. You haven't yet managed to recapture really half of what it lost then. So it does need to get above that sort of 69, 70 area to start getting positive longer term again. So at the moment, I'm just looking 63, 64 up to 69, 67, 69 area. But that brings us nicely onto the next chart, which is euro sterling. So a big component of the sterling index is euro sterling, because all the old currencies that made up the euro when it got created. But I know from Neil that not many people want to look at this one, but this one always highlights very clearly how that 38.2% retracement has held here. Like we saw before, 38.2%, very important area in FX markets. But we'll go to sterling euro and we'll talk through that, which is the next slide there. So on this slide, this is sterling euro. So let's look at the fall. So you have that fall down there from the 140s and it went down to the 107 area. And then every rally since that collapse through 2015, 2016, 2017, we had that collapse. Every rally since then in sterling euro has been capped by the 38.2%. It doesn't quite work as well on the sterling euro chart, which is why I wanted to show it just now on the sterling euro chart, because it touches more on the sterling euro chart and falls off. But here you can still see the same thing. As it approaches that 38.2%, it falls off it. But the last touches in 2022 actually touched it and fell off it. So we know where the main resistance is. The main resistance is up at that 120, 121.5. So forget all the talks about our interest rates going up, our politicians changing, is this happening, is that happening? You know, how many prime ministers have we had and changed in interest rate policies from 2016 through to now? We've had loads of changes. And every time I read the press, this is going to do this to sterling, this is going to do this to sterling. But look, it's just in that simple range. So to get positive longer term sterling euro, you need it above 121.5 on a quarterly close. It's as simple as that. To get negative on it, you really need to see it below that 107, 109. But shorter term to get negative on it, it would be negative now, I think, if you get below that 20-period moving average. Look how for the last 1, 2, 3, 4 quarters, that's held it as support. It hasn't closed below the 20-period moving average, that pink line. So we can see in there that the support down there should be in the 113.75, 114.75. So let's keep it simple. 113.75, 114.75 should be support. If it starts to get below there, then something's changing for sterling euro, and I'd look for further weakness to come. Top side, we know the 120, 121.45 area. hasn't been up there for some time now. So let's put something in between. 117.20, 117.30 is probably an area where if it gets to, it's going to find some resistance. So let's just keep it simple like that. All we're going to look at is those three levels, three areas. Why complicate it? You know, why worry about all these other stuff that I read in the newspaper and hear on the radio about? Anyway, let's go to the next slide. The next slide is sterling dollar. And on sterling dollar here, we can see it's the quarterly chart. On here, we have the Bollinger Bands and the retracements, which we've looked at for a long time. We can see what has held it. It has been the 23.6% retracement at 129 and the 20-period moving average 127.78. That area, the sort of 128, 129 area, has capped sterling dollar for the last 3 quarters. So that's for the last 9 months. And where have we seen the support come? The support has come on all those pullbacks within those 9 months at the 38.2%, which is the 120 area. In fact, last year, early on for the last quarter, I said, watch that range. I said, watch a range there probably of, just let me get there. I said, watch 120, 122 as support and 127.75 as resistance. And the last quarter of 2023 saw a low of 120.37 and a high of 128.28. So I think those levels work well for those last few months. So now we know we've got the Bollinger Band and the Fibonacci retracement at 128.99, so basically 129 as our resistance. And we know we've got 120 and 122 as support. What else can we do? Let's add a line on to try and help. So if we look at the next slide, I've simply added the downtrend line. So I know Duncan at work, he likes this line a lot. It's a very good trend line that comes down. And we can see that if we go to the next slide, I'm actually going to zoom in. And now you can see we broke that trend line very slightly at the end of last quarter. But I'm always wary of end of year quarters. It's not a huge break of the trend line. So I'd like a bit more confirmation. You know, I'd probably like to see a quarterly close above 133. And then if we got a quarterly close above 133, then I'd start talking about the 139, 140 area. But at the moment, while you're below that 129, below that 133, you haven't quite got the break, I don't feel. We know where the support is located, that 120, 122. I might move it up slightly and say 123.75, 124 area on the long-term chart, and sort of have that as an area where if you got below 123.75, 124, then maybe sterling dollar is starting to struggle and we're not going to get that break. But if we go back one slide, one point worth noting is look how quickly it's retested. So before, when it's hit that trend line, it's fallen off very quickly. This time, it's hit that line again very quickly after the last test of that line. And before, on the first 2 instances, it fell off quickly. On these instances, it hangs around the trend line. It tells you that the sellers aren't quite so quick to sell. And what does that mean? If the sellers aren't so quick to sell, it doesn't take much for the buyers to break the trend line. So we've got to keep an eye on that 129 area, 129, 133. Really keep an eye on that during this first quarter. And then the last slide is the elephant in the room. No, not this slide. Yeah, this slide. So this is the elephant in the room, the 8-year cycle. So I put this chart back in 2015. I started talking about this cycle. I talked about it way back in 2007. Every time there was reasons why, oh no, it's not going to work this time. But every 8th year, sterling dollar seems to have a negative year. So it's just worth keeping that in mind. Now, I got told I got lucky last time because it was Brexit. I got told I got lucky the time before because it was a financial crisis. But let's see if I get lucky this year. But you have to look at price more than cycles. Cycles are secondary. Price is always king. So if it gets above that 133, we have to be wary of that. But this cycle, we mustn't forget, there's there's the risk that sterling dollar goes down and ends the year lower this year. But anyway, Neil, I really apologise that because I feel like I've been Brian. It leaves you only just about 1 minute to talk about the fundamental mumbo jumbo, but maybe go into the question time a bit. Sorry.
Thank you very much, Piers, and very interesting. I'm reminded of a quote from Gary Player, actually, when he was told he was very lucky chipping out of bunkers because he always used to get it very close to the hole. And he said, yeah, it's amazing. The more I practice, the luckier I get. So maybe it's down to the amount of practice that you've had at technicals. Anyway, on to the economic outlook, the economic mumbo jumbo, as you've described it. I'm going to go straight into the details. So if we go on to the next slide. Now, this table was produced in our year ahead forecast, and I think accurately depicts what we expect, not just for 2024, but for 2025, which is that 2024 is going to be a tough year. 2025 looks as if it's going to be a year of slightly faster recovery. So we've got a contraction in the UK, a weak growth from the US and Euroland, weaker growth from China, and weaker global growth as well. And even the recovery when it comes from the likes of the rest of the world, rather than necessarily the major economies listed here, it's going to be relatively anemic in 2025 because we're still being weighed down by higher interest rates for the most part and for most economies. Now, if we move on to the next slide, I think in terms of the prospects for interest rate cuts, this will really be determined by what happens on inflation. And we've seen some encouraging news as far as inflation is concerned. So headline rates are falling back towards target, and we'd expect to get close to, if not there, by the end of this year. And there's been noticeable signs of disinflation in some areas of inflation. So if we look at Europe in particular, we saw the Dutch inflation numbers go negative relatively recently. We've seen a sizable reduction in the likes of Japanese wage inflation, which I highlighted this morning in our daily note. And we're also seeing falls in core consumer price inflation rates, but it's worthwhile mentioning that those falls in core inflation rates have been slower because there's some embedded domestic inflation pressure from wage inflation in the likes of the UK, the US and Euroland. So that may dissuade central banks from being more aggressive on interest rate cuts, at least in the beginning. But I think as we get more information, more idea of the scale and scope of inflation falls, and then I think that those central banks will become emboldened. We will get deeper rate cuts in the second half of this year than we're liable to get in the first half of the year. And looking at interest rates, which is the next slide, the forecasts show that we're looking for a very sizable fall in US interest rates this year. Now, I'm reminded of the fact that the US did have in situ for the best part of a year, or has had in situ for the best part of a year, an emergency financing program, or funding program for regional banks, because it was only March of last year that we had 3 of the largest banking failures in US history. So it is worthwhile noting that high interest rates are still likely to have a negative effect on lending, on credit conditions, and consequently, I think that could promote a faster pace of interest rate cuts, particularly from the likes of the US Federal Reserve. So we're more aggressive on our forecasts for US rate cuts than the markets are. We're somewhat less aggressive on the cuts that we're liable to see from the UK, because we think that there's still some concern amongst the Bank of England members about the sustainability of inflation, given high wage inflation that we've seen, and we've still got ongoing strike action in a number of sectors that could lead to inflated pay deals in some of those sectors, even whilst the labour markets appear to be loosening. Euroland also saw a tick up in their inflation rate in the latest number, but that was due to the reversal of energy subsidies. So those came to an end, and the December reading rose because of that. But it's still on a sizable downtrend. So I think that there's a case to argue for significant rate cuts, albeit smaller rate cuts in Euroland than we're likely to see out of the UK or the US. And the level that we would expect to see the interest rates bottoming out at, unless there's another sort of clear-cut global credit event or global macroeconomic problem, is much higher than where we saw rates for the majority of the last sort of decade to 15 years. So we're looking at UK rates probably no lower than 3%, US rates no lower than 3%, and Euroland rates no lower than around 2.5% in this cycle. So I think that's worthwhile mentioning. And it will, of course, have an influence, depending on how much interest rates fall in each of these jurisdictions, on how the currencies trade. So if we look at the next slide, and I wanted to highlight this, so we've got these three big elections coming up. Now, the polling data in the UK at the moment show the Labour Party with a big double-digit lead on average, but that could be materially weakened as we get closer to the election, and as all of the political parties lay out their strategy with regard to taxes, spending for the coming years. And I think weak growth is one of the things that is hampering the Conservatives' ability to recover, along with just what appears to be problem after problem emerging as far as not only the UK economy is concerned, but also UK politics. And I still wonder whether the Labour vote is as solid as seemingly suggested. But we'll see. I think soon enough, as we get further into the year, I think we'll get a much sort of better idea of just how strong the vote is as far as Labour is concerned, and also how weak the vote is as far as the Conservatives are concerned. Now, in the US, we've still got the two front runners being Biden and Trump, albeit that there does seemingly appear to be more discourse amongst the Republican and Democratic parties about their preferred candidates or the front runners. It doesn't matter who actually ends up fighting out the US election as far as fiscal policy is concerned, because they've already pre-committed to some very swinging cuts as far as public spending is concerned. So non-defense spending not growing at all this year and only growing by 1% in 2025. Ongoing problems with the debt ceiling, I think, will continue to limit the spending ability of any administration, Republican or Democrat. And I wanted to focus just very quickly on the situation in South Africa, because they are due to hold an election, I believe, by sort of mid-August at the latest. And it's coming around quite quickly. The ANC is facing a significant challenge from other political parties who have formed some sort of grand alliance, saying that if there's a hung parliament, they would effectively come together and form a national coalition to prevent the ANC from continuing in power. So I think that could be interesting in terms of what it means for the commodity market, commodity prices, what it means for emerging markets generally. And overall, I think the South African election has had relatively little coverage in the press, but could be a material market mover for FX markets. So just keep an eye on that, as well as the UK and US election coming up. I think we've got something like 64 elections this year. So a huge number of elections globally, but these are the three main ones that I'm focusing on. If we move on to the next slide, these are just the FX market forecast as in the FX Global Themes document for the 5th of January. You can see that we've got some material improvements in sterling against the US dollar and euro against the US dollar, so US dollar weakness. And it's US dollar weakness because if you go through this slide, what you'll see is dollar weakness against things like the Japanese yen as well, and also probably against things like the Canadian dollar. Some problems here for the dollar, but as Piers has already indicated, there is potentially a storm brewing as far as sterling is concerned. And I think the political risks, the economic risks, the potential for lower interest rates, all of those things can play negatively to sterling against our current forecast. One other thing to highlight is dollar Chinese renminbi. It's one that I've highlighted repeatedly. We did get some improvement in the Chinese currency towards the back end of 2023, but given the dual effects of loose monetary policy and loose fiscal policy, I think that you could see the Chinese currency under pressure, particularly if the Chinese economy doesn't recover as anticipated. So some problems brewing for the Chinese renminbi as well, which could be disinflationary globally as far as the global economy is concerned.
Thanks very much for listening to the webinar. We hope you found it informative. The next in the series will be available shortly.